So here in segment 2, we're going to look at the global growth pressures and the latest World Economic Outlook projections. So when you look at 2024, you can see some of the different shifts. So in 2024, world output is expected to slow from 3 to 2.9%. When you look at advanced economies, you can see that slowdown in general. Germany's expected. Really, that European front is where we see the most pressure points. And then when you look at emerging market, developing economies, things are expected to be fairly sticky. We still believe that 2023 is overstated when you look at China, which they have at 5%. India, has been very strong, and we'll talk more about this in the last segment. But you're just seeing some of the different pivots here that are important to watch, especially when you look at Latin America, some of the pressure that is happening in some of the areas in terms of inflation. Now, the question becomes, and we've talked about this before, the ability they can borrow. So a lot of the growth that was achieved in 2022 was driven or built on the back of a significant amount of debt. And when you look at the ability for these countries to roll, and it's not just emerging markets, it's also developed nations. In the U.S., we've added almost $500 billion to our, if not more at this point, to our deficit in a matter of 18 days. It took us to 1974 to achieve that level of debt. So the rates going up and that continued pressure is going to increase the cost, which is why, Italy, we believe, is grossly overstated. We think Germany is going to continue to see slowdowns into 2024. Same with France. When you look at Europe, they are not on a strong footing, and the same can be said for China. So China is going from 5% to 4.2%. We continue to say that 5% is a pipe dream, which then means that, in our opinion, 2024 is also a problem point, and why we think a lot of this slowdown continues. And here's a good point to kind of look at, where of 61 countries that desperately need debt relief, 27 countries in debt distress owe at least half of their total external public debt to multilateral creditors. For 11 of those countries, the exposure is above 75%. So when you're looking at the level of pressure, and to be honest with you, a lot of these are owed to China and all their different banks under the BRI, as well as the World Bank, or IMF, depending on how the structure was created. And this is not, they can't roll this debt. This debt, either somebody's going to take a haircut, somebody's going to have to take some write-downs. And when you look at the pressure in China right now, it's going to be difficult to have that write down because, what are the assets that you're going to put against it? Which is why when you look at their FX reserves, they continue to dwindle down, because they're using this to try to backstop a lot of these pressure points. Now, one of the things that we've said from the beginning was that currencies used for global payments through SWIFT is going to be more and more allocated to dollars. When there's a fear in the market, dollars becomes the one to turn to. And it's coming at the expense of the euro. One of the things that we've been saying is that the US dollar was going to gain influence at the expense of the euro and the Japanese yen. And that on the other side of it, the renminbi or yuan was going to gain a certain amount of priority within the SWIFT system and within their own trading system, not at the expense of the dollar, but at the expense of the euro and other forms of payment. And that's where, when you look at some of the levels, and one of the things that we were talking to some clients yesterday, and I had said that there was going to be a slowdown in U.S. rates, because U.S. rates obviously ran up, but people are scared. When you're scared, you buy treasuries, and that treasuries, not that yields were going to fall, but you were going to get a cap. And I don't think the cap holds. I think the 10-year goes to 5%. But this is the problem that we continue to see when you look at that taper tantrum, because look at how quickly the rate of change was and how quickly the Fed reacted. Now you have a much faster rate of change, a much bigger change from almost 1% to 5.5%. on a go-forward basis, and the Fed hasn't moved. Now, there's calls for the Fed to pause. They may freeze and not do a November hike. That's something that might have changed in our view right at this point in time, just because of what's happened in the international market, what has happened with Israel and Gaza. But as much as we want to focus on Israel and Gaza, there's other issues abroad in terms of other escalations that are continuing to ramp up, which is why there's a chance we could see some of this pause extend. Now, when we start looking at the market in general, when you start looking at some of those haircuts, here's where we look at 39% of the haircut. And this is, again, going back to the chart in terms of the pressure points of the emerging market debt. Here you can see that the private has that 39%. China, in terms of the different rates and the US and the billions that are out there. I mean, multilateral, 53 billion. China, 34 billion. You look at the rate cut that could happen in terms of what that loss would be: 39% haircut, 64% haircut, and the losses that would mount on top of that. And the question is, is there enough liquidity in these structures, in these systems, to be able to maintain this level of liquidity at these different points? Now, one of the things that we want to rant on for a moment from the C6 perspective, we've been saying that when you look at real estate, real estate is going to be a difficult place to be, especially when you start looking at small businesses and the rent delinquencies that are trending higher. So 40% can't pay. So when you look at the level going from 30% to 40% in Jan to September, it doesn't get much better. And for us, we're selling to the grid, and we have seen time and time again, people will pay their electrical bill because they can't afford to have those lights turn off. They can afford to not pay rent, but if you're using that power to run servers, to run computers, to run machinery, that's the last thing you can get, because that power company has the right within 30 days to turn stuff off. So, and plus you're pulling from a much larger base than one or two renters, which again is why we believe we're in a good position from a C6 perspective. Now, when you look at the U.S. market implied change, obviously things have adjusted. When you look at that expectation of a terminal rate, the view of an increase has diminished. There's a lot that needs to be digested at this point in time. It's likely we do get a freeze and we don't get the raise in November, but in our opinion, it doesn't mean that a raise is off the table in the next few months. It just means that there may be a lot of geopolitical and uncertainty that's going to keep people on the sidelines. Now, when you look at the rapid convergence happening with the U.S. Treasury and the nominal GDP, you can see where the pressure is and why we think on the 10-year side, we're going to continue to see that 10-year grinding higher, moving to that 5%, and that again will pull down that GDP activity. Now, when we start looking at the consumer, which will pick up more in the next segment, revolving consumer credit owned and securitized is at $1.28 billion. U.S. consumer credit month on month up 21.2%. So again, you're still seeing a huge shift in terms of the amount of capital that is being borrowed. But it's important to look at it in terms of real versus inflationary. Obviously, the revolving consumer credit at $1.28 trillion. But then if you adjust it on the real basis, we're now back above where we were prior to COVID. So the level has increased exponentially, and revolving consumer credit owned and securitized against disposable personal income is rapidly rising. And as we're going to talk about in the next segment, wages are falling. So inflation is sticky and rising, and we're reaccelerating a bit. You now have this geopolitical uncertainty that's keeping things elevated. And then when you look at this going forward, you're going to continue to see that pressure on the personal income side. So then when we turn to Federal Reserve consumer commercial credit card, all accounts, interest rates for commercial banks are at 21.19%, which means that the average person is probably getting charged anywhere between 22 and 24% on the debt that they are rolling. In a month-on-month terms, average hourly earnings growth was fairly tame at 0.2% versus 0.3%. And again, it's just you're seeing that walk down in hourly earnings as you see more pressure, as you see prices going up in terms of just how people are trying to manage their day-to-day. While, again, people are not going into the office, it's kind of locked in at this 50% occupancy rate, which we don't see changing, and which is, again, why we see more pressure on rents. U.S. averagely earnings coming down, and then when you look at it on an average hourly earning year-over-year basis, you can see that it continues to drift lower and is now back below inflation, which again is showing some of that additional pressure, which we think is going to get a bit worse. And we'll talk more about that in the next segment.